In this webinar, I have made comparison of current economic events sweeping the tripolar economic world, the US, Europe, and China. Number 1. Despite limited hiring and stagnant housing markets, which are two major challenges of the US economy, the economy has improved in its other economic fundamentals in December 2012. Part of this improvement might also be driven by the Christmas and New Year retail sales. The earning multiples are very attractive on the Wall Street, much below the historic standards. Any economic stabilization in the US can unleash high potential of earnings sitting on the Wall Street. Option traders are already bullish as reflected by recent surge in the call put options ratio. The key indicator of optimism is some improvement in the unemployment data released recently. Despite this optimism, I do not see the US interest rates climbing anytime in near future due to European economic recession. Number 2, the energy sector, notably oil and natural gas, have not picked up any momentum. Oil declined a bit on news of surging inventories in the US and is currently hovering around $100 a barrel in New York. Natural gas prices also faced downward pressure on prediction of mild winter in the US. Yields on short-term treasury notes slumped and dollar weakened on amount of optimism news in the US stock markets. Weakening of dollar is a positive sign in terms of boosting of exports and potential improvement in the current account deficits of the US. Number 3. The European economic environment is moving fast toward recession. The GDP of 17 European nations shrank by 0.4% in the last quarter of December 2011 and is expected to decline further by 0.3% in quarter 1 2012. If this prediction is materialized, Europe would certainly need injection of funds to get out of recession. Note, it is already in the middle of recession, with its negative impact on Chinese exports and moderating growth in the US. As well, this will decelerate growth of the global economy in 2012 and beyond, at least in the short-term horizon. Number 4, there is a growing expectation that China is likely to ease its monetary and fiscal policies in 2012. All through 2012, the Chinese central bank tightened its monetary policy due to fears of rising inflation. Ironically, this tightening coupled with credit crunch in rural areas has dampened Chinese growth recently. This situation has been further constrained by the European recession, which snapped some growth from the Chinese exports. Understandably, the current situation in China warrants for some quantitative easing. This will escalate downward pressure on the Chinese currency further, which already has been kept artificially low to the US dollar in order to bolster Chinese exports. Again, this trend can help short-term growth of the Chinese exports, but at the expense of creating another massive currency imbalance between the US and China.